afternoon, everyone. My name is Henry Jim. I'm with Bloomberg Intelligence. I'm an ETF analyst based in Geneva. I've been in ETFs for quite some time now, and at Bloomberg Intelligence, I cover mainly the European ETF industry. I cover the ETF industry from the viewpoint of flows, assets, probability balance, regulations, and trading. For today's webinar, I'm joined by 4 panelists. We have Justin Oliver, CIO at Canaccord Genuity, Ben Seeger-Scott, Head of Multi-Asset Funds at Evelyn Partners, Tapio Koivu, PM at Veritas Pension Insurance, and Abdel Hakim El Attar, Multi-Asset PM at Ares Financial Services. Today we'll be discussing in general how the ETF industry is like and how ETFs are being used by different types of investors. Broadly speaking, we'll be looking at ETFs by asset class, ETF strategies, and actively manage ETFs. Excuse me, get my screen up here. Excuse me, does everyone see the screen right now? Which screen it is on?
Yeah, we can see your screen.
Okay. Can you go to the next slide, please? So like I said, next slide, please. Okay. So the ETF industry right now in Europe, why are we looking at it? Well, it's growing. We've been doubling in assets in Europe every 5 years for the past 15 years. Currently, we stand at 1,978 ETFs issued by 57 ETF issuers with AUM of 1.4 trillion, generating 3 billion euros in revenues. Last year, we had flows, which mean how much money has come into ETFs of 80 billion. But this year to date, these numbers are about August. We had 98 billion flow in already. So we're looking to surpass 100 billion by the end of this year. And turnover last year was twice the AUM at 3.1 trillion, and we're likely to surpass that figure as well this year. Okay, so that's just a general overview of the industry. I'd like to kick off the discussion right now by first looking at asset class. So when I say asset class, we can be talking about equity or fixed income, but also generally speaking, multi-asset or different types of strategies within. So I'd like to open up by asking Justin, if that's all right. As CIO at Canaccord Genuity, when you look at allocations, you're probably not just looking at ETFs, but when you do look at ETFs or other instruments, how do you go about selecting a particular vehicle first and then the strategy?
Sure. Well, thanks very much indeed for the question. I think from our perspective, one of the key metrics that we're looking at, well, there's a few key metrics that we're looking at. Liquidity is key. Obviously, we want to be able to deal, and very often in quite large size, and close to the bid and offer prices. Other things such as that, particularly when you're moving into the more specialist areas of ETFs. So here we're talking whether you're thematic investing predominantly, then you've got to do a fair bit of research in terms of looking at things like theme purity, how much of the index is actually being owned by the ETF. So there's not really just one thing, but I think if I had to narrow it down into one soundbite, what's the key metric for me? It is one of liquidity, which obviously does lead us, I guess, towards a more the larger of the ETF providers in most cases.
And when you say liquidity, are you talking about on-screen volume or the creations, redemptions in the ETF?
I'm talking about what proportion of the typical daily trading size we would be accounting for a particular trade, and obviously that will depend on the size of the position that we're looking to implement or to redeem. But yes, basically, I'm a simple portfolio manager guy. I just want to be able to deal in these things as quickly and as easily as possible. Actually, if I can get away without having to sort of create units or etc., actually that makes it slightly easier for me as well. I'm not a complicated guy, so just keep it nice and simple for me and allow me to deal close to the bid offer spread, please.
Okay, and you mentioned size too, so I would imagine there's some guidelines on not being too much of a percentage of a certain ETF. Are those
Yeah,
the type of characteristics you look at?
yes, that will be one of the metrics that we'll look at. As I say, we'll also be cognizant of how much of maybe some certain stocks that the ETF accounts for. Obviously, it is. I know when you get back down to the basics, it's the liquidity of the underlying asset class investment, which is the most important thing. So obviously that is also a factor. Obviously, if you're dealing in terms of a US Treasury ETF, etc., you're not going to be too worried about liquidity as far as as that's concerned. But lots of different things that I think you want to consider as far as that's concerned.
Okay, thank you, Justin. I would like to pose the similar question to Abdel Hakim. When it seems like for your client base, you might look at similar characteristics, but maybe in a different lens as your more financial services. Do you concur with that, or what other things would you look at when selecting or researching ETFs for your portfolio and your clients?
Well, hello, Jenny. Thanks for the question. Actually, I will probably agree with a lot of what Justin already told about ETF selection. No investor will say otherwise. However, I would add maybe it depends also on the use case of ETF. So, for instance, we have different kind of use case for our ETF in our portfolio. So, when we have a core portfolio kind of component of selection, we'll be more keen about the size, about the price of the ETF itself, because most major indices are very liquid and very large enough that you can go and select. Let's take an example of this S&P 500 or more like MSCI World. These kind of indices are very big and high that have enough liquidity. So we'll be more looking about the asset itself or the provider itself, how it is closed, tracking error of this kind of ETFs. On other side, I think I would go more quickly on the thematics. For instance, ETF will be very keen on looking about how liquid the underlying is, how it is concentrated, because these specific thematic ETF have suffered from this kind of issue where an ETF provider own around 50% of the floating of one single stock. So that's a challenge for us when we're looking at thematic ETFs. I would also add, for instance, for the ETF itself, especially for fixed income or from specific thematic, look how the index is constructed when selecting an ETF. We had a very discussion internally when we're looking for some specific thematic ETF. They have the same name but different performance, and we had to look and understand why we had this kind of case. So I would also bring to the table to look at the index construction rules and the way it's monitored, because that's where your performance comes from, and that's how you can be sure that the position of the portfolio is very, very accurate in this kind of case.
Okay, so your goal as also with any portfolio manager is the performance, and you're really digging under the hood in terms of indices and construction, and also the type of securities in the ETF, right?
Yes, exactly, because our funds are not that big enough that we need to have 1 billion of ETF. So we'll have a position coming from 20 million to around 100 million from specific products. So this kind of size have enough kind of liquidity to the market. So we need to look at the performance on the side and look at the construction of the portfolio of ETFs.
Thank you, Abdel Hakim. Next, maybe I can pose again the same or similar question to Ben. I guess you might be looking across more than one fund. You look at a family of funds. So would you say some of the selection criteria and research are similar in your case?
Well, I think what we're touching on here is, as Abdel Hakim mentioned, is use case, and maybe we can get on that in a little while. It depends what you're looking for these things to do. I mean, Evelyn Partners, I look after our funds. We've got lots of other services. We've got direct private clients. We've got through best of S execution only. So I mean, what we look for, we tend to start because we tend to be a long only wealth manager. I think our starting point is probably strategies and exposure. Often what happens is we will make an asset allocation or a strategy call and say this is the exposure that we want, this is the market we think is going to do well, and then we look at the instruments out there that are best able to match it, and that will start with, as others have said, how the instruments how the index is constructed, what the methodology is, you know, and I'm sure we'll come on later to ETFs just being a wrapper. But, you know, as Justin's also highlighted, you've got to look at all of the points. On the one hand, there's no point getting excellent execution, but you've bought basically the wrong funds. The number of people I know that buy Asia Pacific indices and then a surprise there's no emerging market exposure within it, it's just developed, is quite astounding. So, you know, you've got to get the strategy right, you've got to buy it the right way. At the same time, you're also a bit of a fool if you've got the strategy right, but you haven't thought about the execution, bid offer spreads. You know, buying something like I know a UK large cap ETF that's newly launched is all trading at a premium because of all of the taxes that come in. You can get everything right, but screw up the execution, and you know you've lost 50 basis points on something where otherwise you're haggling or worrying about basis points difference in AMC. So you know, we look at all different parts from our point of view, because we do sort of start with quite an active asset allocation view. Our starting point is what exposures do we want, and then it tends to be these are the list, and look at index construction and implementation. And on the implementation, of course, that's going to depend if we're going to be a long-term buy and hold position, if it's one we're going to want to trade a lot. So lots of different considerations in there.
And in your process, do you actually also consider vehicles besides ETFs?
Yeah, I mean, we use ETFs, we use direct funds, we use segregated mandates, we buy directly. We don't have any self-indexing yet, but I'm sure that's only a matter of time. So, you know, we broadly consider pretty much the whole suite as much as we can.
Okay. And if I may ask, would you say ETFs are a bigger proportion of your allocation or other vehicles? Because we're talking about ETFs today and seeing how they might be better in some cases or not.
It's a hard question to answer. I mean, we're quite a traditional wealth manager, so most of our assets overall are in active funds, but within that we have a range of passive. So our ETF exposure is probably fairly small in our core funds. We often use them for beta exposures in areas that we can't find good active value. But we also have a suite of MPSs and fund of funds that are primarily passive mandates. So, I mean, understandably, our AUM at a business level is quite small. It really depends. We've got quite a lot of blended products as well, where people want a blend of high conviction, high alpha traditional funds, but want to blend that in a way that brings the cost down. So, I mean, it depends on which mandate you're looking at.
Okay, we'll be talking about active later. So, and lastly, Tapio, I would imagine if you're pension insurance clients, would you be more focused on, say, liability-driven investing, or are you also a traditional asset allocation strategy that you employ?
Yeah, thank you. That's a good question. So, of course, as a pension insurance company, the solvency framework affects our decision making to some extent. But I would say on a day-to-day basis, what I'm mostly working on, it's just getting the asset allocation right, and it doesn't actually interfere that much on a day-to-day basis. So I would say it's pretty similar to an asset manager. So we can quite freely, especially because I'm an equity portfolio manager responsible for our listed equity portion. So within listed equities, for example, we can quite freely allocate between different regions and so forth. And also equity weight can vary, but that's kind of a decision that affects our solvency more. So there you need to be a little bit careful. But yeah, all in all, I think we have plenty of room to maneuver, I would say.
And do you use ETFs exclusively, or do you blend it with other equities, directly investing in equities?
Yeah, we use quite a broad range of different instruments. So we have everything from direct equities to different fund vehicles, ETFs, active funds, and also derivatives. Those are all used. but maybe the biggest portion of the portfolio is built on funds, both active and passive. So that's quite balanced mix of different things. And the mixture, it depends on the region. It's quite different if we look at our EM portfolio, which is quite active, and then if we go more to more efficient markets, then it's maybe leaning more towards passive solutions.
Okay, so it's like everyone's mentioned it's use case. So, but speaking of, I guess, tangentially on use case, when it comes to matters of ESG, one could say it's use case for performance, but also investor mandates. So how does ESG fit in all your portfolios? Maybe I can go back to Justin to start there. And how does it relate to ESG ETFs specifically?
Yeah, well, I have to say, if I'm looking at our ESG kind of specific mandates, yes, we've got some ETF exposure in there, but actually most of it tends to be more actively managed. Whether that's, I think one of the drawbacks, I think, of using ETFs in the ESG space actually is potentially that lack of engagement. Obviously, with if you've got an actively managed fund, they can potentially speak and try to promote positive change at some of these companies. Obviously, if you don't have that ability, that option within the ESG side, so I think for us that's a bit of a drawback. As far as that's concerned, we like to make sure our managers are engaging with companies to try to drive that positive change. Yes, we do have some exposure. I think I'm slightly disappointed in some of the pricing. I don't think they're particularly cheap. Actually, they're not offering very often much of a saving, if at all, over that actively managed option that we've got available. So Ben sort of highlighted the fact that obviously we're also a sort of a wealth manager, so we've got the full gamut of investments that we can select from. So we can hold active, we can hold ETFs. Tend to be more towards the active side, say because of that lack of engagement. It's not quite that cheap, but then you do have those index construction issues to take into account. Again, you showed the stats in terms of how many ETFs are out there. We're not underserved in terms of the options which are available to you. So very often, if you're looking at a particular theme, let's say you've got 5 or 6 different ETFs out there, very often you're trying to make what can be decisions on marginal differences in terms of index construction, and to some extent that's not particularly easy. Just because something's done well, we'll go back to the whole past performance isn't the guide to the future. Just because one index construction has done well over the past couple of years doesn't necessarily mean it will outperform necessarily moving forward. So sometimes with an actively managed fund, it can be slightly easier to understand. It can be presented, the fund manager can present how they're looking to construct their ESG fund, whereas maybe that's not quite as obvious on the sort of the ETF side, and say some of those differences between them are very, very small. So that's kind of how we would look at it.
Okay. I just wanted to remind all the participants on this call there, we do take questions that we try to answer them at the end of the webinar. So please enter your questions on the question window at the bottom of your Zoom window if you have any questions. Thanks. Okay, I'd like to pose again the same question to Abdelhakim Altar. How do ESG ETFs fit in your portfolio, if they do, and how do you go about selecting them? There's so many different indices and strategies and mandates now. Is it more investor driven now, or is it more from a company policy?
So it's a very interesting question and a very ongoing debate we had, especially by country, and because we are based in the French markets, and there's this big issue about the label or the ICER kind of certification for each country. We have different mandates, so we have our ESG mandates fund. So in this kind of fund, we are unfortunately looking for ETF and active fund that respects a kind of characteristic in terms of getting the label, the French label of ASR, and that's I would say one of the challenge we have when we're looking for fund or alternative. For now, there is no common kind of framework for all the European countries that we are looking for to have more clarity on that. Yes, the Article 8 and 9 exists, but for our view, it still remain very broad and very complicated to navigate. And I do agree with my colleague Justin about how it's difficult for the index to compare or explain what is the added value of an ESG process in comparison with an active fund. Because active fund tend to have like analysts and explain more about the added value, the engagement policy, and all the kind of aspects, which somehow is difficult to capture in an index constructed ETFs, because they are rule-based and depend on one data provider. And we've seen that the complexity about the ESG data provider is still an issue in the industry. We're trying to discuss with that, unfortunately. And if I want to go deep further, I would look into fixed income in comparison with equity ESG strategy. And I think there's a very big space. So when we are lacking now, it's more like fixed income ESG strategy, especially in a government kind of, or more high yield or very niche kind of strategy that's use ESG principle to cover the asset class. And that's a challenge. For us, I would say that the selection process is quite similar within a normal fund or an ESG fund. So even for our classic mandate, we just put them in one basket and compare all the characteristic or the advantage for each one of them. And if one is better for the use case that we are looking for, we'll go for it. So that's for our global mandate. For our ESG mandate, it's very fundamental to understand the process, how they deal with some sort of qualitative metrics for us, the investment process, the conclusion, the different detail. And unfortunately, we a lot of them get out from the screening process just because they don't respect this kind of engagement policy that we have internally. But still, I do believe that there are some provider there that's use some ESG data provider that's have a very good kind of answer to the ESG problematic for us.
Okay, that's a pretty comprehensive selection process. We at Bloomberg in our numbers, we are seeing that last year we ESG or Article 8 and 9 ETFs were about 60% of flows, whereas this year to date they're only about a quarter. So maybe that might be due to the complexity of the selection process, or are they falling out of favor? What do you think?
It's a funny, interesting question as well. It's funny observation because I think a lot of what's happened last year was this kind of vague about everyone want to get the ESG kind of vibe, and the performance of ESG fund were very good because most of them were tech kind of related, and unfortunately last year the performance of ESG fund was a little bit disappointing because they were excluding energy, and we all know that energy was the key sector to have last year, which is normally not the best kind of ESG sector in this kind of ETF. And I think it's also related to when you have a very difficult market to view, people tend to go to fundamental. And for ESG, it's still a great space to need more understanding. And I think that will explain a little bit about how the euphoria about ESG ETF calmed down. And I just want to measure my words. Not everyone asks for that, but still they're getting more in depth and to understand the process. They want to understand what they have, and they don't want to invest in the first ETF that say they are ESG. So that's what's calmed down a little bit for this year, in my point of view.
Yeah, I would agree with you. You are just taking a breather, but I think it's definitely ESG is a more of an investment focus here in Europe than it is in the States.
Indeed.
Yeah. And Ben, how would ESG funds fit in your allocation if they do, and how do you go about selecting them, given what we talked about all the different nomenclatures and strategies and approaches?
Yeah, well, I mean, ESG is, I still think, an evolving area. Not everyone understands what they mean by ESG, light green, dark green, everything else. I mean, in an ETF context, I don't think ESG, to be honest, fits particularly well in a passive format at all, or even ETFs. I think Justin sort of touched on it. A lot of these are priced at a premium, and if you're a cynic, which I am, one presume, if you're an ETF issuer, your big problem is you've got a lot of high volume, incredibly low cost options, and what you need is something you can charge a premium on. And ESG, capturing a paradigm, seems to be exactly it. And as Abdul Hakim highlighted, that was a great gravy train until last year, when people failed to appreciate this whole thing we keep saying, that ESG is likely to deviate from a main index. Everyone thought that meant outperform. It doesn't. Sometimes it can underperform. So it's a needed sort of maturation. I mean, I think ESG, it depends what you want to do with it, right? If you just want to take a lighter green, if just metrics are important to you, some we can measure. If all you have to do is reduce the emissions in your portfolio, you know, you can do that in quite a narrow way. And I think, you know, if you want to use passives for that, I think maybe it works a little bit. The way I tend to look at it, it's very hard to capture the rules. We all know the scoring systems used for ESG are not particularly fit for purpose at the moment. There's a huge variety out there. The best I think they can do, and we do use some, don't get me wrong, we use some ETFs and some index trackers that are different flavors of ESG. I think if what you're looking to do in your general mandates is just do a little less harm, then ESG tilt simple rules are fine. They can do that. They can screen out some of the worst offenders, get rid of some unconventional weapons and thermal coal, etc., etc. If you want to do active good, you're probably still looking at an active manager that can look at the business model, look at that case. So maybe doing a little less harm. ETFs work in quite a simple way, not so much active good. I think where we tend to use them, passives and ETFs, it isn't that do less harm camp. What we have in some of our passive primary mandates, where we do active asset allocation but use passive instruments, we do use some ESG screened ETFs of various flavors, but specifically these aren't ESG. We explicitly say to people buy them. This is not an ESG mandate, but as we look to embed sort of simple ESG considerations in our investment portfolio, instead of having MSCI World, having some that screens out some of the worst offenders, minimizes some of the impacts on sort of tracking error, tracking difference. But I think replacing some of those core elements may be where ESG is useful. If you don't just want to be beholden to simple market cap weighting, but maybe want to apply a light tilt to a bit less harm. Again, you're not actively doing good. This is not what I would consider ESG or ethical or sustainable investing, but as part of a main investment proposition, if you wanted to use some of those, that tends to be where we use these ESG screened ETFs and index funds.
Okay, and you balance that off obviously versus any impact to performance, right? Is that your main mandate rather than just some ESG exposure?
Absolutely. Again, when I talk about some of those passive mandates that we have, we've taken a decision to use as a starting point some lighter green tilts, not for ESG considerations, but we think longer term that's sensible. But again, if you look last year, when we did think that energy and other areas were going to do well, you know, we made the active decision when we topped up the UK, we just use a FTSE 100 tracker because we wanted the exposure to oil and gas and other things. So we can make active calls on it. But I think as some investment processes start to embed the stuff at a lower level, that's when we'd use them as a default. But again, you know, you look at these things, say, can I, not just is there a difference, but can I see an investable difference? Can I take views on any tracking difference that we have? And if it's no strong view, then we'd probably use it in some of our mandates for a default. And maybe that's some of our use case for the ESG ETFs.
Okay, thank you. And last but not least, Tapio, how do ESG strategies, specifically in ETF form, play a role in your world, especially since most ESG ETFs currently, as that Hakim had mentioned, are equities? Do you use them, and how does it fit in, and how would you go around evaluating them?
Yeah, of course, ESG is very much integrated in all of our investment decisions, and equity indices and passive products are no exception there. So definitely that's an important part of the evaluation. But yeah, as the others have already pointed out, it's not simple because there is this kind of trying to find the optimal balance between tracking error, and how well constructed ESG profile you will get out of that. So it's a difficult equation to solve. So far, I would say we are leaning if we talk about our broader exposure to equity markets in general, like broad market benchmarks, we tend to favor those kind of indices that have some kind of ESG element to it. But so far, I think how we see it is that if you have just a simple screening process that you exclude a couple of securities, it's as pointed out, it's quite good way to improve your metrics to some extent, but it's not really the end solution. And as a company, we don't that much believe just passively screening out securities, but still that's the first step. And I think we are still waiting for really good solutions in passive format to do that. And as long as there's nothing better, I think that's one way to do it. And but you need to, and we pay quite a lot of attention to tracking error, that there's ESG, different versions of ESG screened and ESG linked ETFs do, and we try to find the optimal place where you can actually improve, for example, your carbon metrics, but it's not just excluding the energy sector. Last year was a good reminder that it's not smart way to do it, and we are needing energy also in the future. So you need to try to be invested there as well. So I think we try to find those solutions that are more sector neutral, but still that favor those companies that have better ESG profiles, and especially those companies that are improving. That's I think where some of the impact lies. It's not just how it looks as today, but what is the direction. But it's not totally straightforward to construct that in the passive format. But I'm relatively optimistic. There's lots of development. New methodologies are launched. There's quite wide offering already of different kind of solutions, from very simple screens to quite advanced, I would say, paradise aligned indices that actually also evolve over time. So there's plenty of opportunities and different alternatives. We are following the space and kind of trying to find the right place to be. But that's actually one of the challenges, because the ESG is evolving so fast. So it's in that makes it a little bit harder for passive investors as well to be ESG investor, because what you think about ESG evolves every year, and as your thinking evolves, your needs and how you see different products change as well, and it creates kind of a need to adjust the portfolio over time as well, which is not like very well aligned with the basic passive investment mindset.
And that's actually a very good segue into our third area of discussion, which are active ETFs. And I say it's a good segue because you've highlighted some of the potential shortcomings of embedding ESG mandates or policies in a passive strategy. Like, I guess if you don't mind, since we're on the topic, do you think an active ETF with an ESG mandate might be better? Of course, it depends on the manager and all, but would that be something you look at? And then maybe also give some thoughts on active ETFs in general, please.
Yeah, definitely. I think that could be one of the solutions, because in ESG, there's quite often kind of judgment that you need to make, and it's maybe hard to make in purely systematic manner, because there's kind of a human element, especially when you have data that's a little bit contradictory and changes between different providers. So you really need to see through that. And in that case, active management is probably helping. And I think definitely active ETFs could be a big help there. And all in all, it's a very interesting direction. Still, active ETFs in Europe haven't gained that much attention, that much assets, but they are a much more bigger thing in US. Of course, that's probably not driven by ESG, but still, I think Europe could follow, and I suppose there will be more active ETFs coming in the future. And I think it's just positive because, well, what is an ETF? It's just a different fund structure, and if you can trade it intraday in the exchanges, why not? I think it's just an improvement to the fund format.
And here's that's related to a question actually that's directed to Ben, actually, from one of our participants. Ben, you mentioned the use of active strategies and mutual funds. That's where you get some of your exposure. Have you looked at active ETFs, or is it or not? Is it because of the lack of strategies, or performance, or pricing?
Well, I think I have looked at active ETFs. Obviously, being European based, as many have highlighted, there are lots of active ETFs in the US, not very many over here, and I'm not quite sure they're going to come wholesale over here, because a lot of the advantages, particularly around tax, are very pronounced in the US. They don't really apply here. Most of the mutual funds that we have in Europe have very similar tax treatment in terms of pass-through of the various costs. So I think active ETFs are clearly taking off, but my sense, and it's entirely possible that I'm massively wrong on this, but my sense there'll be a different flavour. When we tend to think of active funds in the US, rightly or wrongly, they tend to be a bit more concentrated. I don't see Terry Smith or someone launching a 20 to 30 stock ETF anytime soon of full active management. And that tends to be most of the active funds that we're used to over here. You get to see a fund manager that talks to you about the stocks that he or she likes, and here's their business model, and this, that, and the other. I'm not really sure there's a massive push to shift those into an ETF structure. That would be down to the asset manager saying, look, we're pushing this way. Maybe it's down to plumbing. It's slightly easier. You've got less plumbing and regulatory registration issues and stuff like that. But part of the answer to the question as to why we don't use many is there aren't very many out there, certainly in the active space that we use. But I think my sense is that the trigger and the shift is probably going to be a broadening out of these discussions. And if you think about ETFs, most people think they're synonymous with passive. We've already had that passive and then factor tilts, and then the question, is that a little bit active? Obviously, I know not ETFs, but in index funds, Vanguard tried to launch some and then close them down, but said, look, these are active, even though they're systematic. I think maybe some of those systematic factors in an ETF structure could be where they come through, or human stock picking, but at broad scale, right? So following relatively simple processes with fairly large numbers and getting that diversification across. So it's still very much early days. It probably works a little better in fixed income, where you can do more individual stock picking. Very few people are going to be bothered to just replicate that themselves. Obviously, fixed income's a very broad universe. You've got lots of different things to manage. It's quite a hard market to get into. So I think some of that stock picking is likely to come through. But most of the active ETF providers, certainly that cover market to me and that are readily available to us, there is that tilt between some has quite heavy human involvement, some is more systematic, but they're both considered flavors of active. And that's a relatively new aspect to parts of the European market, certainly the wealth management space that I sit in. So the answer to why don't I use those active strategies in ETF format is the types of fully active strategies that we look at simply aren't yet available. And I'd be surprised if many of the groups, particularly the boutiques that deploy these types of strategies would want to do it in an active ETF structure. I think the active ETFs we're going to see will have a different flavor to them.
Thank you. And since you mentioned fixed income, and Abdelhakim, you also mentioned fixed income, although you talked about ESG strategies. But if you were to look at a fixed income ESG strategy, would you look at an active ETF or look at a mutual fund? And why?
Actually, it's it's quite. I would say we already have one of active ETF in our strategy, but that's one simple case when we put the analysis of all the fund, passive and active, and this particular ETF stand out. I would agree with my colleague because the challenge of active ETFs that are systematic for the moment. There's no pure stock picking kind of active ETF. And I think it will take some time because people still have this misunderstanding that ETF, active ETF in Europe or ETF themselves are kind of passive way of replicating an index. So we still are lacking the way we don't see ETF as a wrapper that we can use in terms of pushing forward the strategy for Jove or with adding more layer of liquidity and less complexity for a couple of investors. So that's for now, we're still suffering from the lack of understanding of viewing ETF as a wrapper. And that's make it a little bit difficult also for boutique because most of the performing active fund are kind of boutique kind of oriented, so they lack more resource. And ETF wrapper need more resource to be set in place. They need specific expertise. So that's one of, I would say, the challenge they have in the industry. For ESG, I think that's a space where active ETF can play a big role because fixed income as well has been a little bit active even for passive fund because they tend to have a kind of semantic way to selecting kind of a basket, optimizing it, selecting kind of some very big name and doing their flavor of active management for fixed income products. So I agree with you. I think ESG can be a very good approach. And by the way, if you look at fixed income ESG products, most of them are Article 8. And they kind of add this kind of layer of ESG when they do selection because they prove to have more maybe resilience or maybe adding more attraction to investor. We don't know yet which one of them is the key factor behind that, but I think that's something will probably have a very good place in the space of ETF.
Thank you. Actually, before posing the same question as Justin, there is a question online that is related to what we're talking about here. In terms of SFDR Articles 8 or 9, how important is that for the panelists here when selecting ETF? Is that part of your selection criteria when choosing an ETF? Focus on ESG? Maybe start with you, Abdelhakim, since you were talking about those Article 8 and 9.
So, well, truth be told, no, not yet, because for us, the ESG factor of looking at is more the local label that we have, or the kind of the local point of saying, yes, this is an ESG kind of strategy. And this is more, I would say, commercial kind of related to our markets and our understanding of our clients. So they understand better to this kind of structure. Still, we have a couple of institutional investors or clients that tend to require more of Article 8 rather than 9. But I think Article 8 is good enough, but we don't go over the dichotomy of it is 9 or 8 is that's complicated. For now, that's not part of our selection process, if I would say that.
So lastly, Justin, in regards to both active ETFs and maybe even touch on Articles 8 and 9, when you're looking at your suite of ETFs, what do you think of active ETFs? You mentioned price and liquidity were an issue before, and we also mentioned the dearth of active ETFs in Europe. Is that your same opinion, or anything else you look at?
Yeah, I'll try and say a few different things that haven't already been said. Conceptually, have I got any problem with active ETFs? No. But that said, we don't have an exposure, at this moment in time. I think for us, why are we investing in an ETF, in the first place? Well, we've kind of touched on some of those reasons. It's like, theme purity, or you're looking for the certainty of a particular index return. And I'm not entirely sure that for me that an actively managed ETF offers enough advantages, enough plus points really for me to want to go down that route rather than maybe an open-ended fund. Yeah, certainly think in terms of cost again, which again is all important. Actually, it's now let's say an actively managed open-ended fund is a better solution. Well, certainly is for us as a firm, not least because we can get access to very lower cost share classes, and obviously you don't have that differentiation in terms of an ETF. It's all basically one price. And actually, I think in many cases, because we're obviously buying in bulk as an institutional rate, we're very often getting them below what we might be able to access an ETF at. ETFs. What else would you use them? Obviously, the intraday trading, the intraday pricing. Okay, but that's fine. But I would suggest that if we're that worried about dealing at 10 o'clock in the morning or maybe 2 o'clock in the afternoon, that's a very, very difficult short-term trading strategy, which again, as a firm, that's not what we're about. Obviously it is nice to be able to deal intraday, but if we have to wait to end of day prices, I'm assuming our rationale for investment has worked out and we've made a nice degree of outperformance. So in that case, we'll kind of settle for the end of day price. So no problems with it conceptually. If we came up across one, that's fine. But it's just for me, for us, I think it's just viewed as a slightly different wrapper, if I can put it that way. Again, it doesn't offer really much different, and maybe we get more access to fund managers, the ability to meet them, etc. by going through the open-ended fund route. In terms of Articles 8 and 9, no broad differentiation between them, but we don't have any restrictions as far as that's concerned.
Okay, well, the general consensus on this panel does concur with some of the numbers we've been seeing here at Bloomberg Intelligence, namely, and this also relates to a question online, we're seeing that in the States, in Europe, active ETFs account for a little over 1, maybe 2% of the assets and maybe 3 or 4% of the revenues. Whereas in the US, it's already grown to like over 5% of the assets and 13% of the revenue. What that's telling us is, like you said, the conversation about whether it's ETF or not, or active or passive, is already done in the US, and they're talking more about access to strategies and exposures, right? I think that is a longer term conversation in Europe, if ever. So yes, I think we concur on that. Okay, well, we've covered the major topics we had to cover. We'd like to focus the next few minutes on some of the questions we've got online. Is that okay? So one that's come up that's, I guess, interesting for this panel will be, how will AI impact index construction? And therefore, of course, your portfolios too. So who would like to start there? Maybe Tapio, since, if you can.
Yeah, that's a tough one because AI will definitely have a huge impact in many ways and in many sectors, and probably investing and index construction is no exception. But it's very hard to see that far into the future. Well, the future may not be that far given all the advances that are happening, but still, it's still quite hard to estimate. But maybe I would compare it to an active manager, because if it's AI-driven process that you really cannot, even though it's systematic, but if it's not like something that you can clearly write the rules and the formulas for the futures, then it's for me like an active manager, and maybe competing in the same space than active management in general versus just pure passive solutions.
You're on mute, Henry.
Okay. Sorry, I was just saying. So for Tapio, it's more of there'll be more of an impact on active rather than on the index construction. Yeah.
Yeah, I think so. Of course, AI can be used as a help when you build indices. That's for sure as well. But I think it's just another tool, and then of course, as of today, you can use different tools, different methodologies to construct indices. So I think it's not that big difference there. But yeah, I think in the active management space, it could be a much bigger thing.
Okay. Any other of our panelists want to take a stab at that?
I mean, I guess I've got a couple of views echoing to an extent what others have said. AI is fascinating. I don't think it's going to come and replace all of the portfolio managers. Like with everything else, I think it's a really powerful tool. Most of the use cases that I sort of envisage, it's a lot of the analysis and the technical bits that are otherwise difficult to do that can replace. If you think about the way that you do research as a team, you can look at trends like, okay, how has this asset class or this index methodology worked historically? Great. How's it worked in inflationary environments? You look at it and say, oh, but how's it worked in inflationary environments, but when employment has been high and falling or low and rising? And each time you do that, you've got to go away and do more research. And if you talk to any sort of researchers, either in finance or in normal academia, what they talk about is the slow step in a lot of this is data analysis, because each time you've got to go away and spend a lot of time and thinking power redoing the analysis. And AI is ultimately a really powerful data analysis tool. And obviously, you're from Bloomberg, so you know this better than most. But it's being able to analyze that data quickly. And imagine, instead of having to, every time we all want to come up with a new approach, we need to get someone to write the code, to put it through all the testing and write a new piece of analysis software. One of the powerful things about AI, I think, is it can do a lot of this on the hoof. And I think it's just going to make our analytics that much more powerful. So I think all of the existing processes will continue. I think it's a really powerful data analytics tool, and that really makes it sort of a much cleaner, more powerful approach. And that's where I see AI coming in, rather than you switch the AI bot on and you switch Ben Seeger-Scott off.
I see the questions being turned on me because of the sheer amounts of time I spend on data. I have the most risk then with AI. All right.
Anyway, if you don't mind me jumping on that question, because it's a very interesting question, and I will just maybe quote what, I don't remember which one of the US bank that used the ChatGPT-4 model in their kind of daily activity. The CIO just said that all their advisor, imagine having all like advisor having direct access to the CIO and more having all the documents analyzed quickly in a very effective manner. I also link that to thematic ETFs or thematic indices, because a lot of definition of thematic is very difficult, and I think AI can bring more edge to the easiness to access data, the quick way to analyze all the aspects, to give more of a very kind of punching approach to constructing portfolio. But still, I think will be also always a human behind that to monitor or guide the AI to what you look at. But still, I'm looking forward to what's interesting aspect they will bring to us.
Okay, we're running to the close here. I'm going to start wrapping up, but we do have one more question that just came in that might be interesting. Maybe we have one or two of you answer it. It says from an anonymous attendee, can you share where ETFs should not be used? Or maybe like, when would you not use an ETF for your portfolio? Does anyone want to take that? Justin, maybe?
Oh, yeah, I'll attempt to answer that one. I don't think there'll be a situation where we'll never use one. I think we do tend to have a preference for using ETFs in the equity space rather than maybe fixed income. We do use fixed income ETFs, but I think they form a larger part of our equity constituents, and probably slightly careful in terms of any ETFs giving exposure maybe to alternatives, just because, again, for the liquidity construction. So again, we might be going full circle here. Yeah, where I do not use them, it would tend to be more where there's issues of liquidity, because again, I think that's more of an issue for the ETFs. I've also got slight issues in terms of the fixed income space, just because I think there are more sort of investment opportunities or abilities to options to add value from fixed income investing on an active space than it is from the ETF space. Very often where the ETF is constructed on the amount of debt, actually you probably want to be investing where there's less debt. You don't want to go into which are very highly indebted areas. So never say never, but preference, I think, for equities over other areas.
Okay, thank you. That makes a lot of sense. That's a whole other session we can do on fixed income. I have my own views, but for today, I'd like to just wrap up by summarizing. We talked about ETFs, generally speaking, use case. So in terms of how to select ETFs, we're really talking about, well, it really depends on what you're aiming to do with them. But things we do look at, according to our panelists, are liquidity, price, exposure, among some other things. These are the general ones we share. From an ESG perspective, ESG seems like it's still an important topic in Europe. It's still growing, but at a slower pace than before. It seems like the definitions are not clear yet, entirely clear, but we're still working through it. And but there is a general consensus that we should be, if not doing, we should be more proactive, but in the meantime, we'll do less harm. And we can get that through ETFs if we look closely enough. And finally, in terms of active ETFs, it seems like we're still at the early stages. The thing holding some of us back for jumping into ETFs is the lack of products right now. Prices, it seems like from my numbers, it seems like there's a lot of downward price pressure on the active ETFs in Europe. So that's not an issue yet, as it is in the States. Okay. Well, I hope everyone on this webinar enjoyed it. I do thank you to our panelists for your time and sharing your insights and how you go about ETFs. I certainly enjoyed it, and I'll hopefully see all of you again. Thank you.
Thank you very much indeed.
Thanks, everyone.